As today marks the end of the year, month, and week, it's time to look at all three to figure out where we go from here. Let's go. What a year it's been, with the S&P up over 24% and the NASDAQ up over 50%. Let's take some time out to figure where we're going next. Many charticians will strike out once we move to all-time highs, but I have tools in my toolkit that'll help us figure out where we'll go next. Stay tuned. Starting with SPY, let's look at the yearly. And for the yearly charts, I went ahead and put them on log, as due to the price changes, when you started in the $40 in SPY and now we're up to $475 and change, you have to put that in log scale or you just won't get the right look and feel to it. Just like 2022 was almost a complete reversal over 2021, 2023 was a complete reversal over 2022. And as I mentioned earlier, we're up over 24% this year on the S&P 500. So, many people feeling better about where we're at from the year prior. And if we look back in time, we can see here that, this corrective wave played over quite a bit of time. And since 2008 now, we've really been in quite a bull run where we've been holding that 5 EMA all the way up. In fact, we wicked off of that area last year. Now, if you heard me say 5 EMA for exponential moving average and you're wondering what that's all about, I'll go ahead and link a video at the end of this one talking about moving averages. And this way you can learn all about simple moving averages, exponential moving averages, and get you in tune to what we're talking about here. We'll look at the SPY monthly in a bit, but now let's look at tech. The Q's reversal was even stronger, as you can see here, that we completely engulfed this one and set a new all-time high. And this guy was up over 50% this year. What a run. And there's no doubt that the AI train helped this one get its wheels set in motion. But everybody's wondering, is it over? Are we going to now reverse going into next year? And we're going to have to peel into the monthly to get a little bit better understanding of where we're going next. But before going there, let's look at the small caps. And the first thing we're going to notice here is a pair of wicks. Now, this year we came close to the 13 EMA and retesting that. But really, this double bottom was super strong. We reversed off of it. And this year, which admittingly we made mostly in the last couple months, we're up now over 15% on those small caps. Just like a rising interest rate yield environment was bad for small caps, we can expect now that we've kind of settled out, the interest rates will be dropping. Could we see a lot more upside on this one, and could it be the darling for 2024? So let's go back to SPY now, and we'll look at the monthly. And let's look at this 5-wave impulsive structure that we see here and talk about it a little bit. Now, one thing we notice right away is if we look at this first impulsive wave right here, we'll notice that the corrective wave pulled back about 50%. And we can do this with our retrace tool. So we can see here, that we almost, really came back and spiked that 618, but Elliott is based off of closing prices. So we were right at that 50% retrace where we pulled back. So then wave 3 was a good one to get into for the year. And if we go ahead and, look at this third wave, and the impulsive wave is typically the largest wave. With our retrace tool, we can also see here that we pulled back about a 50% retrace on that third wave. So now if we go ahead and zoom in a bit, one thing we know about Elliott waves is that typically the first wave and the fifth wave are typically about the same length. So if we're able to copy the length of this first wave and move it over to the end of the fourth wave, which started the fifth wave, we can see right now that we've kind of run the course of this fifth wave. Now, the fifth wave would be able to run a little bit more if we didn't have an extension in the third wave. So let's just check out the third wave. So if we go ahead and use our fib extension tool, we can see that, we came up into this area, then we pulled back, and then we can see here that this 1.618 fib level, which is a normal extension level, we just about hit that to the penny. So that means that, we're probably in an area here where, we're going to see a momentum shift or some type of pullback coming. Now, we're going to go into a little bit deeper about talking about a pullback here and what that means and being a buy the dip opportunity, as we're going to look at SPY Weekly in a bit. But let's just say that, we're in an area where I'm not saying we can't make all-time highs before we reverse. In fact, I would like to see that. And I'll link a video at the end of this one that explains why I want to break the all-time high and why it's important, according to Elliott wave rules, but I'm not going to get into that now. Now, I know this can look a little bit confusing here, so I'm going to try to build this piece by piece, and eventually we'll be adding not only the put to call ratio, but the SPY Weekly to this as well. So this is a weekly chart. And on the bottom here, we can see the percentage of stocks trading above their 50-day simple moving average by week. And one thing that we've talked about before is that, just like I told at the bottom was a good buy opportunity, we're now getting into an area, where we're starting to see, the percentage of stocks, above 90, 88, 90%. So it's getting into an area where, we've seen reversals in the past. So first, let's add the put to call ratio. So now you can see that I've added the put to call ratio in yellow. Now I'm going to strike a horizontal line at 1. Now the reason I struck a line at 1 is anytime we're below 1, that means that, people or retail are buying calls. And if it's above 1, and the more it is above 1 means they're buying puts. Now, typically this is a contrarian indicator, as retail almost always gets this wrong. They're buying calls when they should be buying puts and vice versa. And now finally, if we add SPY Weekly, and we'll put some text on there as well in orange, we can now see that, we have a good indication of when the put to call ratio is low and we were starting to get frothy with the percentage of stocks trading above their 50-day simple moving average. And it looked like we were coming into a local peak area. Now, one thing I talked about in the past is, these weren't necessarily a good buying opportunity when we were coming into a raising interest rate environment. As we can see over here as well, this was the start of the correction that we had throughout the summer. But if we look over here and we see when they were, doing monetary policy that was easing, it wasn't necessarily a bad time to buy, but it was a matter of kind of timing it somewhat. So let's talk about that a little bit. So if we look at these areas that I'm going to highlight here, wherever they occurred, typically once this happened, we had some type of consolidation or we had some type of pullback. Like over in here, we had a 5% pullback before moving higher. So being that we're at a local high, and I'm not saying that we can't make one last push to get that SPY all-time high before reversing. And like I said earlier, I hope we do. Looking at SPY Weekly, we've been up 9 weeks in a row. And if we look at this, we'll see here that 1, 2, 3, 4, this bar is actually a higher close than 4 bars ago. And every other bar fits the same bill, which means that on the weekly, we have a 9 count sell signal. And if I were to pop over to the daily, and I'm not, we actually have a 13-day sell signal. And this signals buyer exhaustion. Now, using the fib retrace tool, I've gone ahead and drawn the retrace, and you can see there that the 50% retrace lines up with the blue 20 simple moving average. So we're likely to see a pullback of about 5 to 6%. And we would likely see this in some form of corrective wave where we come back down and do one of these zigzags before then, maybe finding some footing and then resuming that bull trend, maybe in February. If you're finding this technical analysis useful, then go ahead and subscribe, as my analyses include more than just telling subscribers we could move higher or we could move lower. Now, the Russell has had quite a run as well, but when we look here, we notice this week on the Russell, we got a topping tail right at an area of strong resistance. Now, I would like IWM just to go ahead and take off, but maybe is the 5 EMA likely to come back up, and maybe this come back down and retest that before moving higher. And this type of rotation, maybe from some of the other big runners we've seen last year with the NASDAQ and rotating into the small caps, would that make a little more sense? Also, if bank earnings go well, as a large portion of the Russell is made up of banks and financial institutions. When we now flip back over to the yearly and look at the US10Y yields, we see that we put in a doji. And when we see a doji, that means, this either could be an area of continuation or an area of reversal. But being that the Fed said that likely yields have peaked, I'm going to go with the second case. I think that this is more of an area of reversal. And if yields are dropping, that typically means that equities will be moving higher, especially the ones that have just gotten destroyed in the past year, as they'll have some ground to make up. And if yields have peaked, then that means if we look at TLT and bonds, that bonds historically at like a historical level have likely bottomed. And even if you miss this bottom, this looks like one heck of a reversal candle. And that means it could be a good buying opportunity for bonds as well. I typically go ahead and load up on TMF, as that's the 3x bull of TLT. And I can make a lot more doing that. Of course, if it goes the other way, you can lose a lot more too. So I'm always careful to trade it with a stop loss and take profits on the way up, as I do all my trades. And when we look at the VIX, it just got obliterated this year. And if we look over here to the left, we're still under 13 on the VIX, which pretty much suggests all fear has left the market. So with the VIX getting crushed, yields dropping, and the Fed cutting interest rates to avoid a recession and have a soft landing, to me, all that seems bullish. So if we enter 2024, maybe have one last hurrah to hit an all-time high, and then go ahead and spend some time pulling back into the first part of January into February, I'm going to try to be patient to get the next buy the dip opportunity. Well, that's a wrap for 2023 as we say goodbye to a year that saw the AI train take us back to all-time highs for the NASDAQ and within shooting distance for SPY. I'm wishing everyone a happy new year to you and yours, and hopefully a terrific trading year ahead, as that's all I have for now until our next video, and we'll see you then.